Hi, I'm Mal from the Money Study, bringing you another episode in our Take 10 challenge, and we're up to number 6. Basically, comparing what happens if we save more money, or what happens if we get some good investment returns, or basically both would be nice. Before we kick off with the details, there's my disclaimer: facts and figures, it's information only, it's not advice. Interesting that when I got into finance initially, I sort of spent a hell of a long time there just focusing on investment returns. I'd have all my spreadsheets spread out there. I'd look at this, I'd look at that. I'd be forever chasing different things to see if I could squeeze out a little bit more money so it earned me another 0.1% or whatever. And trying to work out, should I indeed have more in my shares? Should I have more international than my domestic shares? And I spent an inordinate amount of time just comparing and moving money around. And I say, just trying to squeeze out that little bit extra. And so here I was spending all this time doing it, but then I'd effectively, go out to dinner with some mates or so forth, and and buy a few drinks and get a taxi home or whatever. Easily spend $100, just go bang. So would it really have mattered what I was investing in the start if I really could have put that extra $100 into my investment instead? Because we've got to look at what we are contributing and what that does to the growth of the account, especially in the earlier days. Because in the earlier days, you see, the level of savings is far more important. It's how regularly you're putting money in and how much are you putting in compared to the investment returns, because you've only got a small account. So if you've only got a small account and it makes 1% or 10%, you're only getting a small gain on your initial investment. But of course, if you're adding hundreds and thousands of dollars to your account on a regular basis, that's making a greater difference. And of course, as your investment gets bigger and bigger and bigger and bigger, yes, a 3, 4, 5%, or even just a 1% difference in returns on $1 million account, that can be delightful. And pales in insignificance in comparison to the fact that you might be putting in an extra $100 or so. So this is an example here. You've got a $10,000 investment and you're contributing $200 a month. So if you put in $200 a month, that's an extra $2,400. And so on your $10,000 investment, at the end of the 12 months, you've now got $12,400 because you've got the $10,000 investment and you've basically put in that extra money. So that's an increase. That's an increase of 24%, even if the money wasn't invested. So even if it was making zero returns, even if you had it under the bed, which I'm not suggesting that's a good idea, but in theory, by just adding to it with no investment returns, no interest rate on it, not in the bank or whatever the case may be, we just made 24% on our investment. It's grown by 24%. But of course, a 5% investment return, so let's say we've got our $10,000 investment and we make our 5%, then effectively that's only $500. So even though we've got this lovely 5% return, we made $500. And so comparing that to, if we weren't contributing, you can see there that this thing's not really growing overly quickly, even with a reasonable rate of return. Now, of course, if you're comparing that to a $500,000 investment with making the same contributions, getting the $2,400, then the increase by contributions is only a 0.48 of 1%. So the contributions aren't really making a big deal at all. But the 5% return, on a $500,000 investment, now we're talking $25,000. So you can see that our focus should be changing. Now, as I say, obviously, if you're putting in your $200 a month and you got the 5% on our $10,000, that's certainly going to help. That's certainly going to help. But it's not really something that we really need to stress too much about, in the regard that an extra 1% on a $10,000 investment isn't going to make a hell of a difference to the scenario. It's more the case of finding more money to put in. So we've got to look at those expected savings compared to expected investment returns. And then obviously the one that gives you the most benefit, so normally in the earlier days we're going to be looking at contributing. Later on, then we can start focusing on that investment business. But of course, if we're into a situation where it's sort of looking pretty similar, okay, we'll focus on both. I mean, ideally, of course, we can just keep on contributing, irrespective of the contributions may not be making a hell of an impact later on. If we've got spare money and we can put it away to grow our wealth, then why not? Now, of course, retirees, we don't normally have spare income as such. We're drawing down on our super to live on. And therefore, retirees do need to focus on their investment returns to ensure that their money is going to last long enough. But of course, we've always got to worry about the risk. It's simple to say that, we've just looked at chase bigger returns. Generally speaking, if we're chasing bigger returns, we're taking on a higher risk to get that higher return. And I'll certainly be going through risk in a lot of other sessions coming forward there. So, and remembering when you're comparing all these things, there's always a case of comparing, your net return after all the fees. It's what did this thing actually make after the fees is concerned? Because the fees can certainly have an impact if you're moving from one product to another product or another type of investment. And yes, you're making an extra 0.5%. But your fees are an extra 1%. Well, you've actually gone backwards. And with any investment, of course, we do need to take inflation into account. Obviously, when interest rates on our bank account was like about 0.25 of 1%, and inflation was starting to then, go up and up and up, our money in our bank account was actually going backwards in real terms. And people were chasing other investments, which is fine while things are going well. We've just got to be careful of this whole business that everything goes in cycles. So we've had a good run on the share market. At some point, we're going to have a bad run on the share market. We're going to have low interest rates, then we're going to have good interest rates, and then we'll have low interest rates again. And it's knowing what's going on. And this is what this is all about, is the more we understand the jargon, the more we listen to find out what's happening, the easier it is for us to make decisions about our money that makes a little bit more sense as to where we can put that money. So we talk about making money, what about losses? So you can afford to take on a greater risk when you're starting out, because you see a loss of 20%, on a $10,000 investment is $2,000. So we lose $2,000, and of course, losing 20% is harsh, but to lose $2,000 is nowhere near as devastating, well, it might be initially, but in comparison to someone who has $100,000 invested, who has a $500,000 invested and then loses 20%, where they lose $100,000. So you can see this, and this is why generally financial planners and so forth, anything you read suggests that a younger person can take on higher risk, literally because they've got less money. But also they've got time on their side for it to rebound and come back and pick up for the losses. An older person, we are, running out of time as far as, I'm not saying you're going to die, but basically once we don't have any other income coming in, if we get a loss at the same time we're pulling money out of our account, that just sort of amplifies the problem. And I will be talking about this a little bit in another session as well. So you can see that, if you did have a 20% loss on your $10,000, your contributions, if you're putting in this $200 a month, $2,400, at the end of the year, it would look like your account didn't even go backwards, even though you lost $2,000 because you put in $2,400. At the end of the year, you'd say, oh, well, yeah, I've gone forward. And so that certainly can help. Little comment there, we probably shouldn't even mind a downturn in the earlier years while we're starting out, because, as I say, usually a downturn is followed by an upswing. And so if we did lose, and as soon as we just started an investment at the age of 22 or something, and it went backwards a little bit, we only lose a tiny amount, but then in theory the market would turn, or interest rates would change, or whatever the situation is. So all of a sudden we now start to build as our investment improves over time there. So a lot of things to sort of take into account, but it's really what I'm trying to get across in this session is really the focus. That it's not just a case of focusing purely on what this thing is going to pay us. It's also on the risk involved, and it's also the dollar value that we've got invested, whether we should be focusing more on just trying to find an extra $100 to put into our account. All good fun. Look forward to talking to you on another session.